Okay, welcome everyone. I'm Kevin Davey, KJ Trading Systems, and today we're going to talk about trading games that people play. And I'm going to go through a bunch of different ways that trading results you see aren't really what you'll get, and knowing some of these things will help you out a great deal as you try to trade and try to look at things out there in the trading world. So, with that, we'll get started. All right, so today we're going to talk about first all the different ways, or at least a bunch of different ways, that trading results can fool you. Then I'm going to do a book giveaway at the very end, and we'll have time for questions and answers. And if you have questions during the presentation, type them in, and if I am able to answer them during the presentation, I will. If not, I'll do it afterwards. So I don't know what the weather's like for you, but for us, I'm up in Ohio, and it went from nice fall weather where there were leaves still on the trees, as you can see, to a few inches of snow on the ground in one day, and it was like under 10 degrees yesterday. So I'm in Cleveland, which is on the shores of Lake Erie. I have it circled over here, and at least I'm not in Buffalo, and that's over here. They had probably 3 to 5 feet of snow, and what happens is there's something called lake effect snow, where the winds blow on Lake Erie and blow that way, and once it hits land, it picks up all that water and just turns to snow and just dumps it on Buffalo. So, hey, at least I'm not in Buffalo. Hopefully it's warmer where you are, though, than I am. Anyways, that's our weather and geography lesson today, and I won't be asking questions on it later, so don't worry about it. All right, but I will be asking a question. I'm going to throw up a poll here real quick. I just want to get a sense of people who are here, how many years they've been trading. So if you get a chance to answer this poll, a little later on I'll show you the results. Okay, and we'll close that poll right now. Probably about half of you are saying you have 2 to 5 years of trading experience, and a quarter of you are saying 5 to 10 years, and a quarter of you are saying 10 plus years. So there's quite a bit of a trading experience in the room here. So some of these things I'll be talking about you've probably already seen, but some are probably new to you, or maybe hopefully I'll present it in a different way that will get you thinking. So I've got some upcoming free webinars. They'll either be in December or in January of next year, or going into the rest of winter. So as long as you're on my email list, you'll be notified of it. If you're not, just go to my website and sign up. And of course, these are all free. You can also follow me on Twitter, and you'll be notified that way too. So with that, for those of you who don't know about my book, I just want to do a quick book plugging. Building Winning Algorithmic Trading Systems. And so that this is how I transformed my trading from being a losing trader into actually being a winning trader. And I think it's a worthwhile read. Of course, I wrote it, so of course I think that, right? So with that, I'll just put up the disclaimer, and then we'll get into our talk. But anything I'm going to be showing here, consider hypothetical. We'll be talking a lot about hypothetical results today, so definitely want to keep that in mind. But this is a good U.S. government disclaimer that we should always keep in mind. All right, so let's get into it. Trading games that people play. A while back, a couple of years ago, I ran a survey, and I asked people what they thought some of the tricks were out in trading. And people said a lot of the things I'm going to talk about today. People show results ignoring commissions and slippage, or they use back tests that incorrectly, and there's a lot of other things. So that's what we're going to kind of talk about today. And the big thing over all this is what I call the golden rule of any kind of trading system results. Now, these could be results that you create yourself. They could be results that you see somebody on the internet create. They could be from a trading signal service, anywhere. Remember this rule that's in red. Too good to be true probably is. And that holds up for any kind of trading results you see. If it just looks too good where you just look at it and you say, wow, that can't be, chances are you're probably right. And given the amount of experience you guys have, everybody has at least probably 2 years experience who's in on this call. You've seen enough out there that you know what's real and what's not real and what's achievable and it's not. So, the tricky part, myself included, is sometimes you see results and you immediately want to believe it. And you just got to remind yourself, too good to be true probably is. For people who say, hey, I'm selling the Holy Grail and this is the best system ever, chances are if it was that great, they wouldn't be selling it. And that's the bottom line. But that doesn't mean it can't be a good system. There's a lot of people who do sell good advice, good systems, and it's just not the be-all and end-all of trading systems. So that's something to keep in mind. So that's just the golden rule. So keep that in mind as we kind of go through all this. And you'll see results time and time again, things with trading that just look too good to be true, and it turns out they are. So the other part of that is just treat everything you see as hypothetical. And what does hypothetical mean? That means it could happen. Not that it did happen, but it could happen to you. And my guideline is, if it happened in your account, your own trading account, then treat that as real, because that's real. But everything else. So, I could show you results, your next door neighbor could show you results, your accountant could show you results. Doesn't matter who, it's all hypothetical because it didn't happen in your account. So that's the other key point to keep in mind as we talk about all this stuff. Just treat everything as hypothetical, and then if in the back of your mind you're going to know, hey, maybe this isn't real, or maybe I can't achieve it for whatever reason. And we'll show some of those right now. Okay, so we're going to look at what are the ways these hypothetical results, these games that people are playing. What are some different ways people do it? And why are these results bad? It's important to realize the bad parts about all these results. And then the biggest thing is how you can avoid it in your own trading, and as you're either looking to trade or looking at things out there. This is going to be important. Well, here's one. This is kind of a bonus one that I added in. I don't know if you guys read trading blogs. You probably do. They're out on the internet. I read these things and I'm just amazed because these people never lose. It's incredible. So here's one on the left that just 3 days in a row made money in everything. He was trading the euro, trading the ES, crude oil, the FDAX. It doesn't matter. This dude made money no matter what. Then there's another blog where every day for 2 weeks this guy was making money. 5-6 points a day consistently. And then down in the corner there's somebody trading all these stocks. Oh, they had 2 losers, but they also had, according to them, $69,000 in winners. I'm not showing some of them, but you look at that and you probably, if you're like me, you probably get depressed because you're like, hey, my trading's not that good. Well, keep this in mind. It's all hypothetical. And, there's a famous quote out there that I've modified a little bit, but Abe Lincoln said the problem with internet trading results is you can't always depend on their accuracy. Now, if you get the little joke there, then you know what I mean by this, but you got to watch out for any results you see on the internet. That's the big thing. Those trading blogs, I don't know if they're winning all the time like they said they are, but I'm sure if they're trying to get customers, that's one way to do it. All right, so now let's look at 8 other ways that people are playing games with trading results. All right, the first one, this is easy because we've all done it and there's a lot of people out there who do it, is over-optimization or curve fitting. I always use this example of mutual funds. If you're like me, one way to pick mutual funds, the way I always used to do it was I'd pick up a magazine or look at a table on the internet and find the best ones over the past 5 years, and whatever the best ones, hey, I'd pick it and put money into it because, hey, those were the best performers, right? Seems logical, but all you've done is you've just optimized for net return of all these mutual funds, so it doesn't work. The best ones today aren't necessarily going to be the best ones tomorrow. And in fact, if you believe in things like mean reversion, some of the best ones today might actually do worse than a lot others in the next year. So trading systems, if you see a trading curve that looks like this, that's just this perfect, almost perfect upslope, making new equity highs, which are the little green dots, chances are that was over-optimized. It was curve fit. And I know this one was because I actually created it just to show that point. It took me about 5 minutes using Tradestation to actually create this and probably optimize it to death. But it created this great-looking equity curve. And again, too good to be true? Yes. And over-optimize and curve fit. And so that's probably the first trap. That's a trap most people fall into because they're just dazzled by this equity curve. They see an equity curve that looks like that and think, hey, I've got to get on board that. That looks great. It's a trap, friends. All right, so what is not too good to be true? Here's an example. This is a trading system I actually trade myself, and I've traded it for a couple of years, anything to the right of this blue line. And you can see it's walk forward trading results, which are out of sample, and it had a significant flat period. It had some pretty horrendous drawdowns. Didn't last long, but it had some down periods. Even live, it had a pretty significant drawdown. But the thing is, they're believable. Most people would look at this. They might not particularly really like it. That's fine. But they might say, well, hey, if this dude was faking these results, they'd look a lot better. Either he's a terrible faker or maybe they're real. So that's what you kind of want to look for when you see these kind of hypothetical results. You want to see something realistic. That previous curve I showed you, I mean, you can tell that was unrealistic. This one, there's ups and downs. It's definitely not a smooth ride, but it's going in the right direction. Okay, so optimized curve fit. Why is that bad? Well, when you do those kind of things, you're relying that the future is going to be just like the past. And if it was, those systems would work perfectly. Well, the fact is, that's not how it works. It's never going to work. And the way to avoid it, if you're creating your own systems, here's some tips. You want to limit the number of variables and the number of rules your system uses. You want to use walk-forward testing out of sample. Do some kind of out-of-sample testing. Don't rely on in-sample results to do any evaluation. And before you commit real money, you want to let your system run real time where you can watch it and see what it does. Don't jump into trading immediately after creating your system. And then if you buy systems, a lot of you guys are system buyers out there, or maybe you lease some signals. Obviously, avoid the curves that just look tremendous, because there's a problem with them. Research the person who's selling it. Ask a lot of questions. Hopefully they offer some kind of guarantee. We'll use it. And even with those, even ones you buy, don't start trading those immediately, even though that's your tendency. Wait a while. Make sure it still works. And then you'll see pretty quickly if somebody just over-optimized something and that's what they sold you. And unfortunately, there's a lot of people out there who do. So you got to be really careful. All right, hypothetical trap number 2. Commissions and slippage not included. And this is a big one. And there's a lot of people out there who will show you results and they won't include either. They'll claim they don't get slippage, or they'll claim that, well, their commissions are going to be different than yours, so therefore they shouldn't show them. Run from those kind of people, because slippage and commission are huge factors in being a profitable trader. Here's an example. This is a trading system with the blue with no slippage and commission, and the pink purpley line with it. And so that's a 34% reduction in performance. That is significant. And it might, depending on the system, actually turn a system that's profitable and turn it unprofitable, especially with scalping systems. That is very likely. Okay, somebody's asking, what is slippage? Well, slippage is, Drew's asking it. It's a good question, Drew. Slippage is, there's always a bid and ask on any price that's out there. So if you want to buy, you're not going to buy at the bid, at the lower price. You're going to pay that higher price. So you're going to pay that spread price. Now, that's slippage. That's just what you pay. Slippage can also be when you have stop orders in the market at a certain price, and the market will tend to go past your stop orders, and a lot of times you'll get a worse price than what you wanted. That's slippage too. Two different characteristics to it, but the important thing is, depending on how you set up your orders, your market orders, your stop orders, you've got to account for it in your testing and evaluation. And this is probably a good opportunity to bring up, sorry about that, to bring up what kind of traders you guys are, because that'll help me with some of the slippage questions. So I have a real quick question for you. Are you mechanical or rule-based, discretionary, or a mix of both styles? So let's see what we got out there. I'll give about 30 seconds or so to get people to answer. And slippage is going to apply to both of you. It's going to apply to no matter which way you trade. And the only way you get away without having slippage is if you use limit orders to enter and limit orders to exit. And depending on your system, you can't do that. Andrew's asking, and I'll get to it in a second. He's somehow reading 2 slides ahead. Do I use slippage I experience in real trades or some other amount? I'll get to that in a second, Andrew. Okay, so it looks like of the people here, about a third are mechanical rule-based traders, about 10% are discretionary, and about 60% or so are actually a mix of both styles. So it doesn't matter if you're a discretionary or mechanical trader. Both of you experience slippage. And so slippage, you can think of it as just paying the spread costs. You're going to pay it. Okay. Well, why is it bad when people don't put that in there? Obviously, it's not going to give you a true sense of the profit and loss. The other thing that most people don't understand and that they forget about or don't even think about is it leads to over trading. And think about it. If you were trading some kind of high-speed little scalping system that you developed and you did not include slippage and commission, what would be the best way to trade that? It would be to take a ton of trades. The more trades, the better. So if you could take 100 trades, great. If you could take 1,000, even better, because you're making this little bit of money on each trade. Well, what happens now if you include cost, you include slippage, you include commissions in there? Well, now all of a sudden, you might have been making only a few dollars per trade. Now you're actually losing. So what it's going to do, it's going to tell you, hey, you shouldn't be trading as much because you're losing money. That's what keeping slippage and commission out do. They actually make you trade more than you should. So, take it to an extreme. Go from scalping to being just a swing trader where you make one trade every 3 days. Slippage and commission aren't going to be a big factor for the swing trader. They're going to be a huge factor for a in and out scalper. So, well, how can you avoid this? Obviously, if you see people advertising any kind of results that don't include slippage and commission, I would not walk away from them. I would run, because they're hiding something. There's a reason they're not doing it. And they'll say, oh, yeah, my broker's different than yours, so you'll have different commissions, so you can just add it in. And that's not the point, because that doesn't take care of the overtrading. Some people will claim, I saw some joker once explain that he got no slippage with market orders in natural gas. I'm just like, what kind of person would even make up stuff like that? I mean, you can't make it up, but people say it. It's just amazing. You want to run from people like that because obviously he doesn't know what he's talking about. So, and if you're developing your own systems, oh, thanks, Drew. I'm not sure why you can't see the slideshow. But if you're, hang on one second. Oh, sorry about that. Thanks, Drew, for bringing that up. That couldn't see the slide. If you're developing your own systems, just add it in yourself. Add it in at the beginning. Now, there's times where I do some of my testing where I don't use slippage and commission, but that's the preliminary testing. I just want to see if I have an edge or something like that. That's okay, but when I'm creating full-out systems, you can bet I'm putting commission and slippage in there. I'm putting in at least $5 a round turn for commission. That's if I'm doing it myself and with my broker. That's pretty reasonable. And then I'm always adding 1 to 2 ticks round trip for slippage. So I even add more on certain things. So for gold, for example, if you're using market orders to get in and out of gold, you probably want to use probably 3 or 4 ticks round turn for slippage. And then to Andrew's question, do I use a real amount or not? What I do is I'll estimate it. 1 to 2 ticks per round turn. That's pretty good. But then I'll actually use the data later on to validate my slippage estimate. So I track that a lot of times. And if I'm off, especially on a system that has a low net profit, average trade profit, you better believe I'm going to put that back in there, because that might tell me that I'm so close to the edge I shouldn't be trading this system. So you really want to make sure you put in slippage and commission in there. And, you guys are obviously experienced traders. You might be saying, well, who doesn't do that? You'd be amazed how many people don't do that, especially even experienced traders. It's mind-boggling some of the time. All right. Okay, so the next one, trading trap number 3. A lot of people will show you back tests over the last 6 months, 4 months, whatever, because they'll say, well, I'm using tick data, so blah, blah, blah. And they show you this nice curve. Now this optimized, yes, it doesn't look really curve fit because there's some drawdowns. So you might look at this and think it's pretty realistic until you check out what it says for the time period. And you can see there's 6 months total, and that includes all over here. So this is actually a 4-month optimized test. That might change your mind a little bit. Why? Well, there you go. After optimization, that's what that looks like, this particular system. So it looked great in optimization, but once you start running it live, it doesn't look so good. I mean, it's okay. It's about break even, but it certainly doesn't look like the last 4 months. That's a trap. When people will just take a short time frame and create results based on that. Why do they do that? Well, one, it's a heck of a lot easier to create a trading system on 4 months of data than it is 4 years. Guarantee that, because I've done it. You know, short time frames are pretty easy. It's when you start getting longer times, it gets tough. And then it's tuned to the market. And so once the market type changes, you know, this might have all been a bull market that you just saw that went to a flat market, then that system's going to fall apart. So how can you avoid this? Well, do 5 to 10 years for a back test for a start. Anything under a year, I would not look at at all. And most strategies are based on tick charts because people only have usually 6 months of data. That's what you get. Now, it doesn't mean you can't screw up with the long-term curves. You can still over-optimize with 5 to 10 years, that's for sure, of data. You can definitely do that, but you're a lot more likely to do it on shorter periods. So keep that in mind. All right, so those are probably the biggest 3, I would say. Well, now I'm going to look at some other ones. They're not as well known. Some of them might be to some of you, but they're just as hazardous to your account. So what are they? Okay, the first one's the classic limit order issue. And I'm saying this isn't that well known because I see so many times on trading forums where people will say, here's my equity curve, and you know, it looks perfect. And they'll say, well, I use limit orders, and I use limit if touched. That means if the price touched the market, you know, touched my limit price, then I was filled. Well, the reality is you almost never get filled when the market just touches your price. I've had cases where the market's touched my price a dozen times, 24 times, and I still have not gotten filled. Probably 80 to 90% of the time, if the market just touches your price, you won't get filled. Occasionally you will get filled. Makes a big difference though, because if you do this fill only when touched, you can get buys right at the bottom of the bar and sells right at the top of the bar. So what do I mean by that? Well, if you look here, you can see you actually shorted at the top tick. Well, the reality is you're not going to be able to short right there. You're going to short on a limit order. It would have to go 1 tick higher for you. And that's gets a lot of people because it can easily turn a winning trading system into a loser if you assume that limit orders have to go through your price before they're filled. Pretty common. A lot of people fall for this, and it can really turn disastrous. Somebody I know was telling me about a course he took where they gave a trading system and the results looked great, and so he fired up either Tradestation or Ninja and saw that they were doing touch limit orders, and he just changed it to price must be exceeded for a limit order fill, and it went from a 45-degree up curve to a 45-degree down curve. That's what limit orders did to them. So got to watch out for those. It's completely unrealistic. Now the flip side is when you assume that the price has to go through your price, well, then you run into sometimes where you get these bonus fills where, you know, the price will fill if it's touched. But hey, it's better to be conservative is what I always say than to be unrealistic. How can you avoid this? Well, you know, if you see somebody showing results, just look at a price chart. And if they're consistently or even more than a couple times on a chart buying at the low tick or selling at the high tick, you know they're doing this. And again, I said earlier, run away from a developer who doesn't use commissions and slippage. Run away from a developer who uses touch limit orders and says there's something that's actually real. Because the real world, not possible. I guarantee you, you can't do this. You can do it once in a while. You just can't do it consistently. All right. This one's going to be probably the trickiest one to understand. So I'm going to take a little bit of time. This is, some people call it recalculations. Some people just call it the backtest strategy calculations. Depending on the backtest engine, you can really get messed up. What do I mean? Well, let's just say the strategy knows that there was this bar, this price bar. So you have your open, your high, your low, and your close. And let's say you put a stop loss up there, you put your profit target here, and now you're obviously going short. So what happens if the trading software only knows about this bar, doesn't know any other information? What it always assumes, whoops, go to the next slide. What it always assumes here is if the open is closer to the low, it's going to assume that the price moved in this fashion. So it started out here, went down, hit the low, took your profit target out, so you won on this trade, then went up to the high, and then ended at the close. So this would say it's a profitable trade. Okay. Well, the problem is the strategy engine only knew about the open, low, high, and close, and it tried to make an assumption about the way prices moved. Well, what would have happened, or what did happen, if the price did something else? What if the price actually first went up? So it opened here, then went up to the high. Whoops, oh, it just hit your stop loss. You're out of the trade. Then it went down. Well, it doesn't matter now because you're out. And then it went back up again and got out at this close. If the strategy engine knew that's what happened, and there's a way that it can be made to know, all of a sudden your winning trade here turns into a losing trade. And this happens a lot more than you think it does. And it's all because the backtest engine has to make certain assumptions. So scalping systems are notorious for this because you're getting in real quick and out, and you have a real tight stop. And so depending on the assumptions the backtest engine makes, it'll just assume you hit these 1 or 2 tick profits all day long, when the reality is you might not. So how can you avoid this? You got to watch out with scalping systems. I don't even try to test scalping systems because they're just notorious for being inaccurate. You want to use something, Tradestation calls it look inside bar back testing. Other software calls it something else. So what it means is if it was looking at a daily bar, it could actually go down and look at minute bars inside that to figure out what happened first. Was the stop or profit taken first? One other way you can avoid it is, I'll just go back real quick. I had it set up so your stop loss and profit target could be both hit on the same bar. If you move your stop loss so that it would, there's almost no way they could both be hit on the same bar, that would be a lot more accurate. So when both of them are close to the price you enter at, that you get into trouble. But this is a big one. And, talking about scalping systems a little bit more, they frequently have a whole bunch of these traps and these tricks that I'm talking about. And that's why scalping systems look so good on paper but hardly ever work in the real world. They're usually curve fit. A lot of times people won't put slippage in or commissions, which will really affect your average trade result. A lot of times they'll use these limit order fills, which are a joke. A lot of simulators will use limit order fills. Doesn't work. Just doesn't work. And they'll also use this backtest exploit, I call it, where they assume, the backtest assumes one path, and you can take advantage of that with creating a scalping system. So and you think there's not people out there who use these things to create great looking systems? I guarantee you there are. And it probably wouldn't take that long to find them. They're using these tricks and probably some other tricks to give a great equity curve to get you to sign up and say, wow, I can scalp, I'll teach you. Tell you what, scalping for almost everybody is a loser's game, especially with high frequency traders out there. They're just going to rip you to shreds. My experience, don't even waste time doing it. Scalping. All right, so let's look at another game that people play here. Showing performance of closed trades only. Wow, this is kind of a neat one. There was a baseball player for the New York Mets and I think a couple other teams, Lenny Dykstra. He was a pretty good baseball player. After he was done, he ran an option picking service where he'd have 90% winning option trades. Okay, you can do that. That's not that hard, really. Jim Cramer, everybody knows Jim Cramer, said Lenny is one of the great ones in this business. So, wow, you'd see this, you'd say, hey, this dude was a successful baseball player, 90% wins. Jim Cramer says he's a great guy. I'm going with him. Well, you know what he was doing? He was only showing his wins. He'd leave his losers open, bury them somewhere, and all his results he was showing were only closed trade results. Well, what happened with Lenny? He's in prison. Well, he was. I think he got out last year. He went to prison for this and for some other just shady stuff he was doing, but that kind of tells you about his character. He was showing closed trades only. You'd be amazed how many people fall for this one. Industry standard is what's called mark-to-market. Means every day you take your closed trades, you take your open trades, and that gives you your net equity. What he was doing was just taking his closed trades and forgetting about his open ones, which were all negative. That's how he was getting around that. So make sure whenever you look at any kind of performance results, and these are results maybe you generate yourself or things you're looking to buy, make sure all trades are shown, open and closed. That's the way to avoid it. And that's important. All right, what's the next trick? Illiquid markets or huge size. There's two sides to this coin. Here's an example with orange juice. People know orange juice just isn't that liquid. There's not a lot of volume in it. Well, how can that screw you up? Well, check this out. This is at 8 in the morning. So this is right near the open of the orange juice market where the price dropped $300 per contract in 1 minute, and there was just about no volume. It went from this price that you see here. Let me get a pen. went from that price there to there on basically zero volume in a minute. So if your backtest engine or whoever did the test didn't do it right, could actually show a nice fill at a very good price, when the reality is you wouldn't have been filled until it fell. Or you may not have been filled at all. So that's part of it. That's one way that these things can get you. The other way is by just doing this pyramiding, and I like this one because I fell for this way back when I was just beginning trading, where somebody showed a chart of sugar and showed how, I believe this was probably the chart, if you just kept buying in an uptrend, you'd be a millionaire. And they said, well, you only buy 5 contracts at a time every week. That's it, no more. Well, somebody might think right off the bat, hey, that's okay. Well, look what would happen if you had done this. At the peak, you would have owned 190 contracts. That's a huge position. And at one point, you would have had a $1 million drawdown. Of course, you would have made $8 million, over $9 million almost in profit had you gotten out at the peak. But people might not tell you this. They'll just show you, hey, you could have made $8 million in sugar just by buying up in an uptrend. You might think that's real sneaky, but people are playing these tricks all the time. So you just got to watch out. And if you're testing your own strategies, make sure what you're trading is liquid, and make sure you're not putting in some kind of ridiculous pyramid scheme to your trading results, because you'll get great equity curves. You'll get this exponential looking equity curve. But the reality is, in the real world, you're probably not going to be able to trade it. I just want to make sure, if you can hear me, just a quick yes. Somebody mentioned the audio went out. I just want to make sure. Okay. All right. It looks like everyone's saying yes. So, Mikhail, it might just be your... Well, he's not going to hear me, right? I forget these things sometimes doing these webinars. Oh, boy. Anyhow, you want to avoid the thin markets with not a lot of volume, because you might not get the fills your strategy test tells you, and you want to watch out for the pyramiding. Okay, the last trap. You might need a huge account to trade whatever they're showing you. I found this thing on the internet where they had showed some great equity curves, and then down in the fine print it says, hey, we have 150 instruments we're trading. 150? Well, what kind of equity do you need? What kind of account size do you need to trade that? Hint, it's a very big account. Now, that's not to say the results they're given aren't real. They probably are achievable, but they're not achievable for people trading small retail accounts. So just keep that in mind when you see some results, that you might not be able to achieve it just because you can't do all the trades. And that's a problem if you have a small account, because you're not going to be able to diversify. I'm a huge fan of diversification, as you probably know if you've listened to some of my webinars before. And if you're small, you're probably over leveraged. That's bad. Your risk of ruin goes up, and you just can't withstand some losses. So if you find yourself in this kind of situation, try trading mini lots when you can, if there's enough volume. Or if you're doing Forex, try going with the micro, the mini or the micro lots. You'll be able to survive a lot longer, because your goal with a small account is really just to slowly build it up. It's either that, or you just trade recklessly and hope you double or triple your money. I don't recommend that. I recommend a slow approach, and to do that, you want to do small position sizes. And the big thing here is you probably need more money in your account than you think. That's almost always the way it seems to happen. So the key to this, I think, is to properly estimate for whatever you're trading, to estimate the capital requirements. You know, take into account the margin you need, the worst drawdown your system's going to have, and your risk of ruin. I've seen people with winning systems blow out because they were just over-leveraged and they got ruined. So they had a winning system, and it might not even been a system with a big drawdown. It was just they were over-leveraged and got blown out. So that's what you got to watch out for. All right, so to wrap it up, what have we looked at? What are some of the games that are out there that people play who are selling systems, or that can happen to you if you're developing your own system? Curve fitting over optimization, that's a big one. Commissions and slippage, got to include them. Back tests that are only a few months, watch out for those. Watch out for limit orders that are fill when there's a touch. Scalping, watch out for how they're doing that. Closed trades, make sure you're seeing open and closed trades. Make sure you're also trading markets with some volume to them and avoiding huge size, unrealistic size. And recognize what kind of account size you need to trade a particular system before you get too excited about it. So how have I gotten around these things? Because these things are out there and you can fall in this trap if you're developing your own system. I use something that I've developed over time that I teach. It's called the Strategy Factory, where I teach a lot of these tricks and how to avoid them. It's this online webinar I do. It's